Now, Reliance Industries, that's going to be the big number to watch out for today. It'll come out with its numbers post-market. But Sonia's with us to run us through all the key expectations. Hey, Sonia, good morning.
Hi, good morning. Well, for Reliance Industries, the core refining business continues to be quite weak. The gross refining margins have been under pressure this time around. In fact, we are expecting a fall of $1 per barrel on gross refining margins to $8.50 per barrel this quarter. But the real focus will be on the two verticals, which is Rel Geo as well as Reliance Retail. And on that account, the expectation is growth will continue in both. But just to summarize the numbers for you, on the consolidated front, we're expecting the EBITDA for the company to be flat at 21,319 odd crores. The profits will grow just about 2%. That's because the refining business will be under pressure. As I said, in the last quarter, gross refining margins fell to a 9-quarter low of $9.50 a barrel. And this quarter, the expectation is that there will be a further fall of $1 a barrel. This is driven by weak cracks, both for gasoline and naphtha, as well as inventory losses. Also, the Singapore GRMs have fallen to $4.3 a barrel. The petchem business has largely been steady, and this time around as well, the EBITDA for the petchem business is expected to rise by about 2% on a quarter-on-quarter basis. If you look at Rel Geo, of course, Rima will speak to you in greater detail about that. But this time around, Geo revenues are expected to rise by 11% sequentially. Subscriber addition has been very healthy for Geo, but ARPUs are expected to fall. However, the star in the entire piece could be Reliance Retail. Because although it is a small portion of the overall business, now retail and telecom together form 26% of the consolidated EBITDA for Reliance Industries. Hence, a lot of focus will be on these two verticals. For retail itself, Nomura expects the revenues to double on a year-on-year basis to come in at 37,300 crores, and the margins are seen to improve to 4% versus 2.6% year-on-year. Back to you.
All right, Sonia, thanks a lot for that. But all eyes on Geo's performance and its contribution to overall earnings will be there. And Rima is here with all those details. Rima, momentum to continue for Geo?
Well, expect the momentum for the Geo business to continue. So we're working with a sequential improvement of 12.5% in the company's revenues, aided by strong subscriber addition. So in the month of October, we saw more than 10 million subscribers got added, and that seems to be the run rate. So for the full quarter, we're working with a net subscriber addition of 30 million, which would be lower compared to what we saw in the prior quarter. Margin expansion should be there, so we're working with EBITDA margins of 39%, and that will drive more than a 15% increase in the company's profitability. However, the average revenue per user would continue to come down. It used to be more than 150 plus a couple of quarters ago, and this quarter it could come down to 130. The key to track from the management commentary from the statement will be the Geo phone traction, any update on the Geo postpaid plans and the kind of traction it has seen, and also on the FTTH rollout. Also, balance sheet improvement will be tracked closely. They had announced plans to hive off their tower and fiber into a separate entity with the eventual plan to monetize it.
Okay, all right, Rima, thanks so much for that. Well, Hindustan Unilever, that's going to be the other big number that's going to be in focus today. Mangalam joins us to run us through the key expectations. Hey, Mangalam, this time around, what are we expecting?
Well, the stock is virtually at a record high ahead of numbers, unlike what we saw in the previous quarter. So expectations are large. However, this time the expectations are more on the price-led growth rather than the volume-led growth. The stock, remember, not particularly cheap, trades at 52 times FY20 earnings, but has given big returns in the past. So the key numbers we're watching out for: 6 to 8% volume growth, and this comes on a high base of about 11%, and 3 to 4% would be the price-led growth. So 6 to 8% volume growth and 3 to 4% price-led growth would mean a revenue growth of about 11.5%. So 9,600 crore thereabout is what our poll is suggesting. As far as the EBITDA is concerned, that's likely to grow a tad bit higher than the revenue. 21% growth on the EBITDA. That means that the margins expand by almost 150-160 basis points. That's on account of the company's cost-cutting measures, also the price hike, as well as product mix-led growth coming in for the margins. The benefits of lower raw materials would come in the fourth quarter. Net profit growth of close to around 10%. We're expecting a net profit of around 1,450 crores for Hindustan Unilever. What will drive the revenue growth? Well, if you take a look at their core businesses, which is home and personal care business, out there we're expecting about 10 to 12% growth. And in the food and refreshments business, we're expecting a growth of about 8 to 10%. Price mix-led growth is the key point that will resurface in this quarter. In terms of management commentary, we would have liked some update coming in on the anti-profiteering levy, but yesterday, remember, last evening we got the note coming in from from Delhi High Court. They've stayed the order of the NAA. So it's a sentimental relief for HUL. We've got some clarity out there. Apart from that, we need to know the timeline of the integration of GSK Consumer Healthcare business. Remember, that was the big talking point this quarter. And then this is the FMCG bellwether. What they talk about rural demand is taken note of by everyone in the industry. Keep an eye out on that. And competitive intensity, particularly in detergents and personal wash, is something I'll be watching out for.
All right, Manglam, thanks a lot for that. And let's move on as we count down to India Business Leader Awards. CNBC TV 18's Utkarsh Chaturvedi and Ritu Singh enumerate why Siddharth Lal is in the running for the crown of Outstanding Business Leader of the Year at CNBC TV 18's India Business Leader Awards 2018.
Siddharth Lal's success as the MD and CEO of Eicher Motors is no accident. His passion for bikes is what helped him not only revive the Royal Enfield Bullet brand, which was struggling to survive, but energize it into an icon and cult symbol in the world of two-wheelers. When Siddharth Lal took over as the CEO of Royal Enfield at the age of 26 from his father Vikram Lal, he had one target: get the Bullet firing again. And to do this, he decided to stay true to its roots and milk the brand's basic character, its rich history, and a strong base of Royal Enfield enthusiasts, while bringing in innovative technology to make it bigger and badder. Today, the company produces the iconic Classic 350, 500, the Thunderbird, the Himalayan, and the 650 twins. 4 years into this existence, in 2004, Lal was named COO of Eicher Motors, and 2 years later, in 2006, its MD and CEO. In all that time, his focus on Royal Enfield did not waver. At Eicher Motors, he consolidated its diversified business portfolio, which came from over 15 subsidiaries. He did this by selling 13 of the company's businesses like tractors, trading, and garments in the quest for a leaner and efficient organization. Royal Enfield was not one of these businesses, nor was Eicher Trucks. Today, Royal Enfield is one of the most iconic brands in the premium motorcycle industry. In the last fiscal, the company sold over 8 lakh two-wheelers in India alone and has operations in over 50 countries. That's why Siddharth Lal is in the running for the crown of Outstanding Business Leader of the Year at the CNBC TV 18 India Business Leader Awards 2018.